Most people do not get destroyed by a bear market. They get destroyed by standing in cash while inflation keeps taking a small bite out of them every month, until one morning they discover the account is intact, the number still looks polite, and their life is suddenly smaller. That is the first thing I want you to understand. The danger is not always the crash you can see on television. The danger is often the quiet penalty you agree to because fear makes stillness feel intelligent. Fear turns waiting into virtue. Fear turns paralysis into a plan. Fear turns headlines into handcuffs. And once you let that happen, you do not own your capital anymore. Your emotions do. I have spent my life looking for one thing. I do not chase excitement. I do not chase what the crowd is celebrating. I do not chase what sounds futuristic at a cocktail party. I look for the toll gate. I look for the narrow place in the road where everyone has to pass, whether they are confident, terrified, rich, poor, early, or late. If I can find the toll gate, I do not have to be the loudest man in the room. I do not have to predict every twist in the road. I simply have to own the place the traffic cannot avoid. Right now, most people are staring at the fog and missing the gate. They are looking at oil prices, they are looking at layoffs, they are looking at war headlines, they are looking at television economists saying the same word with a grave expression, as if gravity itself has been suspended. And the United States is about to discover a brand new form of pain. They call it stagflation so often that the word starts to sound common, almost routine, like rain in April. It is not routine. It is one of the most abused fear words in finance because it gives frightened people a script. It lets them feel informed while they are really just being cornered. And if you are not careful, that script pushes you into the oldest middle-class mistake in America. You confuse cash with safety hesitation with discipline and emotional relief with sound capital allocation. I want to be very direct with you. If you are waiting for total clarity before you invest, you are volunteering to buy your future at retail. If you need the headlines to stop hurting your feelings before you act, you are telling the market that you will happily show up after the hard money has already been made. If you are hiding in cash because the world looks unstable, you may feel sober, but you are often just paying what I call the stillness tax. The stillness tax is the price you pay for needing to feel safe before you behave intelligently. It is not charged in a single bill. That would be too honest. It is charged in lost years, missed compounding, lower ownership, weaker bargaining power, smaller choices, delayed retirement, and a growing dependence on people and institutions that are not thinking about your freedom. The number in your account may stay flat and respectable, but your future keeps shrinking behind your back. Now let me tell you why this matters so much today. The crowd is acting as if a spike in oil and a burst of geopolitical stress automatically means the entire market must be abandoned. But reality is never that lazy. Big macro disasters do not happen because one scary headline appears. They happen when several gears lock together and stay locked long enough to crush demand, confidence, and credit all at once. A real stagflation spiral is not a slogan. It is a chain reaction. You need a sustained oil shock, not a dramatic weekend. You need underlying economic weakness, not just nervous talking points. You need unemployment pressure that sticks, not one ugly print that gets repeated for 3 weeks by people who monetize anxiety. And most of all, you need policy to tighten into the weakness. You need the interest rate gear to turn in the wrong direction and keep turning long enough to break the spine of activity. That is the part almost nobody explains clearly because fear sells better when the mechanism stays blurry. A blurry threat feels infinite. A defined threat can be tested. I prefer definitions. If the fear you are being sold requires several conditions to line up at the same time and remain in place for a long time, then what you have in front of you is not certainty. It is a scenario. may be a dangerous one, but still a scenario. And the market being emotional in the short run, and occasionally ridiculous in the short run, often prices scenarios as if they have already become reality. That is where adult investing begins. Adult investing is not prediction. Adult investing is preparation. It is the discipline of saying, I do not need to know the exact weather next Thursday to understand the value of a strong roof. I do not need to know the exact date of the next panic to understand that panic always produces bargains in things society still needs. I do not need to win the argument on television. I need to identify the toll gate before the crowd realizes it is standing in line to pay. People love to talk about my temperament as if it were mystical. It is not mystical. I simply trained myself to separate price from drama. When everybody around you is celebrating, you should at least ask what they are refusing to see. When everybody around you is terrified, you should at least ask what they are refusing to value. That is not bravery. That is arithmetic with a spine. And arithmetic with a spine is badly needed right now because the average person has been taught to fear the wrong risk. The average person thinks volatility is the main danger. It is not. Volatility is emotional discomfort. Permanent loss of purchasing power is a life sentence. If you spend 20 or 25 years converting labor into dollars and then store those dollars in a place where inflation can keep gnawing on them, you are not being conservative. You are running on a treadmill that gets steeper every year. You are working, but the machine beneath you is carrying your effort backward. I have no romance about cash. Cash is useful. Cash is optionality. Cash is dry powder. Cash is a tool. But long-term cash for the middle class is often a beautiful lie. The banker tells you it is prudent. The frightened neighbor tells you it helps him sleep. The headlines tell you it is responsible. And meanwhile, groceries get more expensive, healthcare gets more expensive, housing gets more expensive, energy gets more expensive, and the cost of waiting keeps compounding while the emotional comfort from waiting expires almost immediately. That is another mechanism I want you to name clearly. I call it the comfort trap. The comfort trap is when a decision lowers your anxiety this month while quietly damaging your freedom 5 years from now. A lot of people live inside that trap for decades. They think they are protecting themselves. What they are actually protecting is their ability to avoid temporary discomfort. They trade long-term leverage for short-term emotional sedation. That bargain feels gentle at first. Then it becomes brutal. Now compare that to broad ownership. Take the ugliest investor you can imagine. Not the brilliant one. Not the perfectly disciplined machine. I mean the person with terrible timing. The poor soul who began investing at an awful moment right before a major collapse, and then had to live through disappointment, crashes, dead years, and repeated reasons to quit. Even that person, if he kept owning productive assets long enough, had a path to recovery and then to very substantial gains. That is the point people keep missing. A bad start in ownership is often survivable. A long life of non-ownership is rarely harmless. The stock market is not safe in the childish sense. It moves, it scares you, it insults your emotions, it punishes vanity, it exposes people who thought a rising market was proof of genius. But the stock market, when approached as ownership of productive enterprise over long periods of time, is one of the few mechanisms ordinary people can use to outrun the erosion that cash guarantees. And yes, the market can take you on a miserable ride. You can live through a lost decade. You can live through a housing collapse. You can live through a pandemic shock. You can live through another painful drawdown that feels unique while it is happening, and obvious after it is over. The question is not whether you can avoid seeing red on a screen. The question is whether you want to participate in the long upward grind of productive capitalism, or whether you want to donate your purchasing power to inflation while pretending abstinence is wisdom. That is the real fork in the road. Once you see that, the next mistake becomes obvious, trying to dance in and out perfectly. That game seduces smart people because it flatters the ego. It whispers, you are not one of the ordinary owners, you are precise, you are tactical, you will sell at the top and buy at the bottom because you understand things other people do not. That voice has emptied many accounts. Market timing is one of the cleanest examples of intelligence being used in the service of self-deception. A person gets one call right and mistakes luck for process. Then he tries to repeat it with higher confidence, and usually with larger amounts of money. The emotional pattern is always the same. Sell because fear feels prudent. Watch prices rise without you. Wait for a better entry. Fail to re-enter. Justify the failure by becoming more bearish. Miss a major leg up. Then finally buy back at a higher price because the pain of being left behind becomes greater than the fear of loss. That is not investing. That is emotional whiplash with brokerage access. The better path is simpler and much less flattering to the ego. You buy productive assets repeatedly. You keep some dry powder because fear eventually produces discounts. And when the crowd is truly sick with panic, you increase your pace instead of losing your mind. That is the heart of rational averaging, not blind optimism, not permanent full throttle buying, not worshiping a chart. It is a system for making sure your emotions do not become the chief investment officer of your life. A regular contribution schedule turns discipline into a machine. And if you want to improve the machine, you do not need a crystal ball. You need rules. When the market is down hard, you buy more. When the market is merely noisy, you keep buying. When the world appears to be ending, but productive capacity is still intact, that is not your cue to flee. That is your cue to remember what ownership means. You own farms that still grow crops. You own businesses that still solve problems. You own networks, brands, software, infrastructure, logistics, and talent that do not disappear, because television discovered a new adjective. The market quotes those things emotionally. Their long-term value is built economically. There is a difference. Now, I want to take you one level deeper because the broad market is only the first layer of this story. The crowd today is not merely afraid of a recession. The crowd is also distracted by the wrong part of the next great buildout. It sees artificial intelligence mostly as spectacle. It sees chatbots, image generation, viral demos, software excitement, celebrity founders, and stock charts that already look like they have run a marathon. That is not where I begin. When I look at any great industrial shift, I ask a much harder question: where is the toll gate? During a gold rush, the dreamers talk about nuggets. The disciplined money studies the supply line. In any new technological boom, the loudest attention flows to the glamorous product, but the most durable economics often live in the narrow passage every competitor must cross. If you can identify that passage, you stop thinking like a tourist and start thinking like an allocator of capital for a while. One obvious passage was energy. That part is not complicated. Advanced computing needs power. Data centers need power. Cooling systems need power, and a world trying to train larger models and run more inference workloads cannot do that on slogans. Electrons are not optional, but here power is not the only gate. Memory is another gate, and most people still do not understand how tight that gate may become. The easiest way to see it is to stop thinking about AI as a clever toy and start thinking about it as an appetite machine. Every step forward in capability creates a larger appetite for context, storage, speed, bandwidth, and persistence. A model that handles more tokens, an agent that remembers more steps, a robotic system that needs faster response, a more autonomous layer that must operate across more variables. All of it pushes in the same direction. More intelligence in operation means more memory pressure underneath the surface. That is the hidden mechanism. The consumer sees, the operator sees the resource stack behind the answer. The investor who wants to get rich has to learn to see the resource stack. This is where a lot of people become lazy. They say, fine, AI is big, so I will just buy whatever name is already famous. That is how crowds think. Crowds are usually late because famous is visible and visible feels safe. But safe looking is not the same as underappreciated. Sometimes the better question is not who has the loudest product, but who owns the toll gate. Nobody can skip. If model complexity rises, if context windows rise, if agents multiply, if robotics becomes real, if ever larger systems must retain and move more information, then memory is not a side dish, memory becomes a choke point. It becomes one of the few places where demand can rise faster than capacity can be built. Now notice what happens to your thinking when you see that clearly. You stop talking about AI as a trend. You start talking about it as a build-out. A build-out has bottlenecks. Bottlenecks create pricing power, scarcity, and strategic importance. And strategic importance, when paired with limited competition and long capacity lead times, is exactly the kind of economic shape I like. I am not interested in owning a dream if I can own the toll gate beneath the dream. That is a much more Buffett way to think. Even when the surface topic looks futuristic, people make a mistake with my name. They hear value investing and imagine it means old things only, dull things only, slow things only. That is not what I ever meant. I meant buying $1 for less than $1 and preferring situations where the economics are easier to understand than the crowd realizes. Sometimes the easiest thing to understand is not the consumer brand at the top. Sometimes it is the memory has that quality. You cannot negotiate with it by force of personality. You cannot tell a training cluster to run on charm. You cannot build context. Heavy systems, while pretending storage and bandwidth, are secondary details. If demand rises hard enough and concentrated supply cannot respond quickly, the gatekeeper matters. And here is another reason this setup becomes interesting. The market often discounts cyclical businesses because it remembers the last time supply got sloppy, pricing collapsed, and investors learned a painful lesson that memory becomes a filter. It makes people cautious, sometimes wisely, sometimes lazily. But when a cyclical industry is suddenly plugged into a secular demand wave, you must ask whether the old mental model is too small for the new reality. That is where money gets made, not by ignoring history, by noticing when history is no longer sufficient. If an industry used to be cyclical, because demand came in waves and capacity could eventually catch up, but now demand is being pulled by a multi-year, perhaps decade-long infrastructure race, then the usual fear attached to the sector may create an opening. The crowd says, "Be careful, this business used to swing." The allocator asks, what if the swings now sit on top of a much higher floor? That difference in framing is worth billions. Consider what happens when only a handful of major players dominate a critical layer of supply and new entrants cannot simply arrive next quarter. Advanced manufacturing capacity is not a lemonade stand. You do not wake up on Monday, decide you want, and become a serious competitor by Friday. You need years, capital, engineering, customer trust, process know-how, and a tolerance for pain that most executives do not possess. That long lead time is a mote of time. I like motes of time. A motive time is when your competitor cannot fix his disadvantage with enthusiasm. He needs years. And during those years, the incumbent can deepen relationships, improve economics, reinvest, and become even harder to dislodge. Now let me translate this into plain life terms. If you are a regular person trying to build freedom, you do not need to become a semiconductor engineer. You do not need to memorize every acronym. You do not need to confuse technical vocabulary with understanding. You need to recognize the shape of the money. The shape of the money here is simple. Fear is temporarily discounting ownership. Inflation is permanently punishing passivity. AI is creating a new infrastructure race. Infrastructure races produce bottlenecks. Bottlenecks produce toll gates. And toll gates are where disciplined capital should look first. That is the logic chain. Notice how different that is from the way most people think. Most people begin with headlines and end with emotion. I begin with incentives and end with allocation. Most people begin with price movement and ask what story explains it. I begin with the mechanism and ask whether price has misjudged it. Most people look for permission. I look for asymmetry. Now we can talk about a concrete expression of that asymmetry. If you survey the memory landscape, you quickly discover something that should matter to any serious investor. Meaningful supply is concentrated, demand is rising, and the next leg of AI is not asking for less memory. It is asking for dramatically more high bandwidth memory. Data center-oriented production and the ability to serve increasingly demanding compute environments are not random details. They are the pipes feeding a system that wants to grow faster than the public fully appreciates. That makes certain companies more than product vendors. It makes them toll collectors. And one name stands out because it sits inside that toll road with a profile the market may still be undervaluing relative to the scale of the build-out. Micron is interesting not because it sounds fashionable. It is interesting because it sits where the pressure is building. If you have a company tied to memory demand, positioned for the data center side of the equation, with improving cash generation, real operating leverage, and a valuation that does not look insane relative to the broad market, then you have the ingredients for a very serious idea. Not a guaranteed one. I do not deal in guarantees, but a serious one. People get into trouble when they confuse a rising stock with a finished opportunity. That is beginner thinking. A stock can be up a great deal and still be early if the underlying demand curve is only beginning to reveal its full shape. Likewise, a stock can look cheap and still be dangerous if the economics are deteriorating. Price movement by itself is not analysis. You have to connect valuation to mechanism, demand to duration, and competition to capacity. That is why I keep returning to the toll gate. The toll gate keeps you honest. It forces you to ask, is this asset merely popular, or is it structurally necessary? Is this revenue stream easy to attack, or does it sit behind time, capital intensity, and customer dependence? Is this opportunity cyclical in a way that destroys the thesis, or cyclical in a way that gives me a better entry into a secular build-out? Those are adult questions. Adult questions lead to adult portfolios. Now let me say something else. Most people do not want to hear, you do not need to find one miracle stock to win. That fantasy hurts more investors than bad luck ever will. You need a system, a broad base of ownership, a rule for regular buying, a rule for buying harder when fear gets severe. And then around that core, a small number of informed high-conviction expressions of major structural themes where the toll gates appear especially attractive. That is a sane architecture for wealth. The core keeps you in the game. The opportunistic layer gives you leverage to exceptional trends. The discipline keeps you from turning opportunity into self-sabotage. Without the system, a good idea still gets ruined by bad behavior. That is why I care so much about psychology. The market can survive your ignorance longer than your ego can survive your emotions. If you are terrified every time a headline turns red, your portfolio is not the real problem. Your nervous system is if you think you can wait for a perfectly comfortable entry. Your analysis is not the real problem. Your need for emotional certainty is if you keep selling productive assets because the crowd found a new word to frighten itself with, your information is not the problem. Your operating system is, I call this your inner committee. Your inner committee is the group of voices inside you that all speak at the worst possible time. One says, preserve what you have. One says, avoid looking foolish. One says, wait until smarter people agree. One says, maybe this time is different. One says, you can always buy later together. They sound prudent together. They can quietly rob you. The purpose of a real investment framework is not merely to pick assets. It is to overrule the inner committee when the inner committee is trying to protect your feelings at the expense of your future. That is why rules matter. Rules are pre-committed courage. If you know you will keep buying broad ownership every month, you do not have to renegotiate with your fear every month. If you know you will add more when the market is deeply off its highs, you do not have to discover bravery on demand in the middle of a panic. If you know you will study toll gates instead of chasing whatever the crowd is currently chanting about, you reduce the odds that your capital gets dragged from one shiny object to the next. This is how compounding becomes practical instead of merely inspirational. Compounding is not magic. It is obedience to a sensible system for longer than your emotions think is reasonable. It is patience with teeth. It is repetition with purpose. It is the willingness to look boring while your wealth is quietly acquiring momentum. The crowd hates that because the crowd wants stimulation. The crowd wants constant evidence. The crowd wants gains it can brag about this quarter. Real wealth is often being built in silence while the crowd is entertaining itself with noise, and silence is uncomfortable for people who mistake action for progress. That is why the opportunity in front of you is larger than it appears. It is not merely that certain assets may be mispriced. It is that human behavior is once again creating a discount through fear, confusion, and impatience. That pattern has made me a lot of money over the decades. Not because I am a prophet, because people in aggregate remain predictably emotional around uncertainty. They lunge, they freeze, they imitate, they panic, they anchor to recent pain. They assume the latest shock will define the whole era. And because they do that, ownership periodically goes on sale, especially in the places where the future still requires concrete infrastructure. Now let us talk about what this means for you, not for some abstract institution. If you are young, your problem is not that markets move too much. Your problem is that you may waste your best compounding years waiting to feel informed enough. You will never feel informed enough. The world does not hand out certainty before the bargain disappears. If you are middle-aged, your problem is sharper. You no longer have unlimited time to recover from cowardice. Every year spent underallocated to productive assets is a year you cannot get back. Your retirement will not be funded by opinions. It will be funded by ownership. If you are older, the temptation becomes even more dangerous because safety starts to feel sacred. But false safety can be ruinous late in life. The right question is not, how do I avoid every fluctuation? The right question is, how do I preserve and grow purchasing power without becoming hostage to inflation and fear? That question pushes you back to the same architecture. Core ownership, rules cash as optionality, not identity, selective toll gates, and the humility to accept that discomfort is part of the admission price. That last part matters. You do not get freedom without paying something first. Usually what you pay is uncertainty. You pay by buying while things still feel unresolved. You pay by continuing while other people are backing away. You pay by accepting that no bell rings at the bottom and no committee grants you emotional clearance. That is the ticket. And once you understand that, the current moment becomes much easier to read. War headlines may continue. Oil can stay noisy. Employment data can wobble. Commentators can keep performing fear for attention. The market can remain jumpy. Fine. None of that changes the basic arithmetic that a rare macro disaster requires more than noise, that inflation remains a permanent enemy of idle capital, and that one of the largest industrial build-outs in modern history is creating new toll gates in plain sight. The crowd sees confusion. I see sorting. Weak hands are being separated from patient capital. Tourists are being separated from owners. Headline addicts are being separated from allocators. This sorting process always feels ugly while it is happening. It is supposed to. If opportunity arrived wrapped in emotional comfort, everybody would take it, and there would be no bargain left. That is why I do not need a perfectly smooth road. I need to know where the toll gate stands when the road gets crowded. And right now I believe broad ownership remains essential. Disciplined buying remains rational, and select AI infrastructure toll gates, especially in memory, deserve serious attention from anyone building wealth over the next 5 to 10 years. Not blind attention, serious attention. Study the economics, study the supply concentration, study the demand path, study the lead times, study the balance sheet and cash generation, study whether the valuation still leaves room for good results, but do not stand outside the arena telling yourself that the future will politely wait until you feel calm. It will not. This is the part where your life on one side is the person who keeps requiring emotional comfort before he allocates capital. He keeps money sitting still because stillness feels safe. He keeps telling himself he will move later, after the election, after the war, after the Fed, after the next data point, after the next correction, after one more article, after one more paycheck, after one more year. Later becomes a habit. Then later becomes an identity. Then later becomes regret. On the other side is the person who accepts the rules of the real game. He understands that cash has a job but cannot be his religion. He understands that ownership is how labor escapes its own limits. He understands that systems beat moods. He understands that fear can create discounts. He understands that the next fortune is rarely made by chasing the loudest story. It is usually made by owning the gate beneath it. That is the choice in front of you. Not left versus right, not bullish versus bearish, not optimism versus pessimism, ownership versus drift, system versus impulse, toll gate thinking versus headline thinking, future purchasing power versus present emotional relief. I cannot make that choice for you. I can only tell you what I have learned after a lifetime of watching human beings repeat the same expensive mistake in different clothing. The market does not require you to be brilliant. It requires you to stop volunteering to be fragile. Do not build your whole financial life around the need to feel comfortable. Do not let inflation pick your pocket while you congratulate yourself for being cautious. Do not confuse a crowded story with a finished story. Do not stare at the traffic and miss the gate, because the door that matters is open right now, and it will not stay open forever. 5 years from now, 10 years from now, this period will not be remembered for the number of frightened headlines it produced. It will be remembered for who used the fear to accumulate ownership and who used the fear as an excuse to hesitate. That is the test. When the road looked uncertain, did you become smaller or did you claim a piece of the toll gate? Your future will answer that question long after the headlines are gone.